Hello and welcome. Principles Accounting 1, 201. This is our final WebEx session for the fall 2020 semester. We are in week 14, which is the last week of our course, last full week of our course, I should say. We are in our last chapter, chapter 14, for this course. It has been a great ride. It's sometimes long, sometimes short, depending on how you look at it. It's been really good, though. I think it's been really good. Most of you are passing the course, and that's fantastic. Uh, we've been very successful in teaching this course online over the past few semesters, and I know that we'll continue to have success teaching this course and the other accounting courses online. I first and foremost want to thank all of you for an awesome semester together. I think that this semester has been relatively smooth given the circumstances. Most of you are passing the course. You're doing well. This is the last week of the course. So what does that mean? By this Sunday night, all of your coursework, including the Chapter 14 quiz, must be submitted by Sunday night. Unfortunately, there are no exceptions to that rule because we're at the end of the course. Sunday night's the last day of our class, right? So if you have any outstanding work that needs to be done, any resubmissions, any homework resubmissions, quiz resubmissions, all of that needs to be done by Sunday night. There are no exceptions. Has to be done by Sunday night. So please, please, please make sure that whatever you have left is done by Sunday night. Because the final exam for this course is scheduled for Tuesday, a week from today. Okay. So good news there. Well, I guess it's good news, right? The final exam covers chapters 9 through 14. Okay. The final exam is worth 20% of your total grade. Okay. The final exam has 20 questions, a mix of true, false, multiple choice, and matching. The final exam is open and available for you to start now. Start today, okay? It's open book, open note. There's no timer. Oh, that's nice. I like that. Please feel comfortable taking the exam. A lot of us, we get test anxiety. I get test anxiety. I don't like things that are timed. I don't like feeling pressured, okay? Especially in a final exam setting. So what does this mean? You can start the final exam now, save, come back to it. It'll save your questions, okay? I strongly recommend that you do that now. Submit your Chapter 14 quiz by Sunday night. Any other work by Sunday night. But at the same time, feel free to start the final exam. I strongly recommend that you do that. So from that, all of your work's due Sunday night, no exceptions, all the work, right? Tuesday, final exam has to be completed by Tuesday night. No exceptions to that rule. Because I need to have your final grades for this course posted to the registrar's office by 5 p.m. on Friday. So please, 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 please make sure you adhere to this. I will be emailing you throughout the next few days, reminding you of this very important due dates. So please do it. Also, if you have not already, please take the course survey. It was emailed to you, I believe, last week by the university. It doesn't come from me. It comes from the university, right? The university sent you an email about course surveys. Please take the course survey. The course survey helps me as a professor. It helps to get me recognized that I'm doing a good job. Hopefully I'm doing a good job. Hopefully you think I'm doing a good job. Please complete the survey. It helps me and it helps the university. It also helps us to improve our courses. You did take a different survey about halfway through the semester. Well, some of you took the survey. I want you to know I take that survey very seriously, your feedback very, very seriously. That helps me to improve the way that I teach. I take your feedback very, very seriously. So please, if you haven't already, take the course survey that the university emailed to you last week. And without further ado, those are my housekeeping announcements. Without further ado, let's go ahead and jump into Chapter 14. Chapter 14. This is our final chapter for the course. Financial statement analysis. Financial statement analysis. In the last chapter, we talked about the statement of cash flows, which is the fourth final financial statement, right? Statement of cash flows has operating activities, investing activities, and financing activities. And we know that those statement of cash flows are a result of day-to-day operations that result from cash coming in and out of the business. So now that we've learned about the income statement, balance sheet, statement of cash flows, statement of retained earnings, now we have enough knowledge to analyze those financial statements. And how do we analyze financial statements? We, of course, compute a bunch of great ratios. Don't be nervous, okay? As long as you follow the steps, and as long as you follow the computation as it's written, you'll be fine, okay? I want you to think of this chapter from a manager's perspective. We analyze financial statements to better understand the financial condition of our business, right? By looking at ratios. So without further ado, let's get started. Financial statement information. It helps us to understand the financial condition of our business. We look at financial information for three reasons, okay? One is liquidity, the second is solvency, and the third is profitability. Liquidity is the company's ability to pay its obligations. Liquidity, the company's ability to pay its obligations. Obligations meaning debts, right? Solvency. Does the company have enough assets to satisfy all of its liabilities? That's solvency. And profitability. Does the company have the ability to make additional revenue to exceed its expenses in order to generate a profit? And we will look at those three dimensions using ratios. So again, liquidity is the company's ability to pay its short-term and long-term debt. Mostly, we're concerned about short-term. The reason why we're mostly concerned about short-term is because we're talking about cash and cash equivalents, or things that can be quickly converted to cash. When we talk about short-term, we're talking about 12 months or less. When we're talking about liquidity, we typically talk about that in terms of short-term. Can I cover my short-term debts? That's what liquidity is concerned with. The definition of liquidity is how quickly I can convert my assets into cash, right? In other words, how quickly can I sell my inventory to turn that into cash? How quickly can I sell my other short-term assets to turn into cash? That's liquidity. Solvency. This is a company's ability to pay all of its debts, okay, by using its assets. I, as an investor or as a manager, am interested in the company's ability to make interest payments and repay its debts. That's solvency. Profitability. Again, I'm interested to know if the company has the ability to generate a profit through earnings. Earnings is the same as revenue. As you know, on the income statement, revenue minus cost of goods sold equals gross profit minus expenses equals net income. That's profitability. If your revenue exceeds all of your expenses, that's profit. That's retained earnings. That's net income. The company's ability to generate retained earnings is profitability. So we look at those dimensions, and to better understand the company's ability to generate a profit, to be solvent, to be liquid, we look at the financial statements and analyze them using ratios. And of course, other analytical methods, but mostly ratios, right? Analytical methods, we look at financial statements as expressed as percentages across various periods. The analytical methods that we use include the horizontal analysis and vertical analysis. Now, it sounds just like it is. Horizontal analysis is where we examine financial statements over time and compare the results to previous year's results. I will look at the income statement from 2020, compare that to 2019, and compare that to 2018. The income statement 2020, 2019, 2018. I will look at the trends, okay? Increase in revenue, decrease in expenses for each line item during those 3 years. That's an analytical method. That's a horizontal analysis. I'm comparing year to year. I'm looking at as expressed as a percentage. Oh, I increased my revenue by 3% in 2020 as compared to 2019. How do I know it's 3%? Well, I took my total revenue expressed as a percentage. And we'll talk more about that. Vertical analysis is where we take everything as a percentage and compare it vertically. For example, on the income statement, I express everything expressed as total revenue. On the balance sheet, I express everything as total assets. And I will do a vertical analysis. We'll talk more about that as well. That's analytical methods. Ratios. Ratios is where I express the financial statements as a percentage from other items within that financial statement. And I take that ratio and I compare it to the industry. I compare it to my competitors. I compare it to my own performance from year to year. Comparisons for analytics and ratios are done over time. I look at my company over time, year to year to year, typically over a 3-year period. I look at the income statement for 3 years, 2020, 2019, 2018. I'll look at the balance sheet for 2 years, 2020, 2019, 2018 sometimes. and the statement of cash flows 2020, 2019. The reason why I compare this 2 to 3 years is to, again, better understand trends, financial performance, liquidity, solvency, profitability. I'll also compare my business performance to other companies during that same time period. Why? I want to know how well my company is performing in comparison to my peers, to my competitors, because it will tell me what I need to do to pivot to become more competitive in the future. So those are the two reasons why we look at our financial statements from an analytical perspective. Earlier, I talked about the horizontal analysis and the vertical analysis. There's a third one called the common-sized statements. This is an analytical method that we use to compare our business to other businesses in our industry, compared to our competitors. We use common-sized statement analysis because there are differences in reporting. If you visit sec.gov, you can look at publicly traded companies' financial statements. You can compare their financial statements to each other. You can also perform vertical and horizontal analysis. Common-sized financial statements helps to cover the gap in financial reporting. For example, if I look at Choice Hotels and Marriott Hotels, and I want to compare the financial performance of both companies, I will use what's called a common-sized financial statement analysis. The reason being is because Choice Hotels reports their earnings in millions. Marriott Hotels reports in thousands. So Choice Hotels in millions, Marriott Hotels in thousands. That's just their structure of reporting. In other words, Choice Hotels will put all those extra zeros in, and Marriott doesn't. Okay? Because they report differently, I can use common-sized financial statements to express those in percentages to be able to compare them evenly. We'll talk more about it. Okay, breaking it down a little bit further. Horizontal analysis. I'm looking at increases and decreases expressed as a percentage on the financial statements. I do this for the income statement and the balance sheet. Statement of cash flows, it's a little more challenging. You could, but income statement and balance sheet, easiest to do. So what do? We're looking at the amount of an increase or decrease expressed as a percent, and also the percentage of increase or decrease. Here it is. Okay, so I want to show you this example. Lincoln Company, 2016, 2015. This is their balance sheet. Now, here we can see, using the horizontal analysis, looking at their current assets, $550,000, 2016, $533,000, 2015. That is an increase of $17,000 between the 2 years, which is a 3.2% increase. I can already hear you, Dr. B, how did you get the 3.2%? The formula for percentages is new minus old divided by old. New minus old divided by old. Think of the brackets, the parentheses. I wish I had like a little tablet to write on. Let me see. Hold on. I might be able to do this. Okay. So for percentages, look at me. I'm doing this with a mouse, okay? So try not to be too critical. new minus old divided by old. Okay? In other words, 2016 minus 2015 divided by 2015. Aren't you glad I don't have a chalkboard? That's terrible. Okay.
Hey, Professor.
Good job.
Oh, thank you.
Hey, man.
You must be glad I don't have a chalkboard. It's bad.
It works good.
Okay, well, sorry. I know it's terrible to read. Okay, so you take your so in other words, you take your 2016 data minus your 2015 data and with the parentheses, right? Meaning you do that first, divided by the 2015 data. So in other words, it would be 550,000 minus 533,000 divided by 533,000. That gets you 3.2%. And that's how we, I don't know, does that work? That's how we, see, this is why I don't do this stuff. I don't know how to get rid of it now. Okay, there we go.
You just had it. Oh, there you go.
That's how we express the percentage. So it's 2016 minus 2015 with the invisible you do that first and then divide by 2015. So 550,000 minus 533,000 divided by 533,000. That gets you to 3.2%. New minus old divided by old. That's the way I can express it. And that's how you get percentages, right? And that's at least through vertical analysis. It's a little bit different in horizontal analysis. It's a little bit different in vertical analysis. So that's the balance sheet. Let's look at the income statement. This is again balance sheet. Kind of breaks it down a little bit further. So this is our current assets. This is the decompressed current assets, 3.2%, just like we saw before. But you could do the same thing for every single line item. If you ever do this in real life, right? If you ever do this in real life, use Excel. Use Excel to do it. It'll save you a ton of time. Microsoft Excel. That's something that I wish students knew more about, and I wish we had more time to teach that in this course. So yeah, that's how it works. New minus old divided by old gets the percentage. So we're looking at the increase or decrease. So you just take the dollar amount minus the new dollar amount minus the old dollar amount to get the change, right? Then you do new minus old divided by old to get the percentage change. And we do that for all the items on the balance sheet and the income statement. Now, what does it do? So the reason why we do that, and we also do it for retained earnings, and you could even do it for the statement of cash flows if you wanted to. The reason why we do that is because as a manager, it tells me where I'm doing well, where my weaknesses are. And it also helps me to identify anomaly changes. What do I mean by anomaly? The word anomaly means a weird change, right? It's weird. It's out there. That's why it's an anomaly, right? So for example, if you look at other expense interest, 2016, 6,000, 2015, 12,000. That's a 50% drop. Something happened, right? So it's like it helps me to quickly identify that something happened. There must have been some weird change for interest expense. What that tells me is I probably paid off some type of long-term debt or short-term debt because I'm paying less in interest expense. But I wouldn't know that just by looking at this. So that's why we do it. That's the important reason why we do horizontal analysis. Now, what about vertical analysis? This is a percentage analysis as in relationship to each component on each financial statement. That's a mouthful, I know. So in other words, I express everything as a percentage and relate it back. On the balance sheet, everything is expressed as a percentage of total assets. Total assets. So on the bottom part of the fraction, it's total assets. Okay. On the stockholders' equity, it's expressed as a percentage of total liabilities. So let's take a look in practice. Okay. So again, you'll notice the difference. This is vertical analysis. We're not so much concerned about dollar changes. I'm more concerned about percent changes. We express on the balance sheet, we express everything as a percentage of total assets. On the income statement, it's expressed as a percentage of total revenue. On the balance sheet, percentage of total assets. Now here's how it works, okay? And I do this for each individual year. Total assets is 100%. We see that current assets is 48.3% for 2016. How did I get 48.3%, you might ask? I take my dollar amount for current assets and I divide that by total assets. That equals 48.3%. I do the same thing for long-term investments, 95,000 divided by 1.139500. That's 8.3%. Property, plant, and equipment divided by total assets. That's 39%. Intangible assets divided by total assets, that's 4.4%. Current liabilities divided by total assets, 18.4%. Long-term liabilities divided by total assets, 8.8%. Total liabilities divided by total assets, 27.2%. So forth and so on. All divided by total assets. Now, interestingly enough, when you get down to total liabilities and total stockholders' equity, it should be 100%. How do we know? Think about the accounting equation. Assets equals liabilities plus equity. Total assets equals total liabilities plus total stockholders' equity. So if assets equals liabilities plus equity, that means 100% equals 100%. So that's why you see that your total assets equals your total liabilities plus stockholders' equity, also 100%. That's how you know you've done it correctly, is when total assets is 100% and total liabilities and stockholders' equity is also 100%. That's vertical analysis. And again, we can do this for the income statement as a percentage of total revenue, also known as a percentage of total sales. And you could also do it on, well, it's kind of challenging to do it. And this is the income statement. We see total revenue, also known as total sales, is your 100%. And then we break everything out. Cost of goods sold, 69.6%. How do we get that? We take 1,043,000 divided by total sales equals 69.6. Gross profit, 455,000 divided by total sales, 30.4%. So how do you know that that's correct? Well, if you add total cost of goods sold and gross profit together, it should equal 100%. And then the other cool thing too is if you add up all these other components, it should be in relative spec. So selling administrative expenses, 191,000 divided by total sales equals 12.8%, so forth and so on. What this tells me is two things. Expressed as a percentage of total sales, what percentage is all of my expenses, each of my expenses, right? That's useful information because it can help me to better control my expenses. I can compare it to last year as a percentage. I see 2016, my total operating expense was 19.7%. I see in 2015 that was 20.4%. So that means my total operating expenses went down and my sales went up, right? My sales went up. So I must have been doing something right in 2016. I must have lower total expense somewhere. I must be more efficiently managing my expenses. That's what that percentage tells me. It's lower compared to the previous year. That means I'm doing something right. So that's why these types of analysis is very, very important to business managers because it helps us to be more efficient. Now let's look at the last financial statement analysis method. It's the common size statement analysis, where everything is expressed as a percentage and there's no dollar amount shown. This is useful for comparing one company to another or to the industry average. Here we have two companies, our company and our competitor. Our company is Lincoln, our competitor is Madison. I can express everything as a percentage of 100% of sales on the income statement, and I can do 100% of total assets on the balance sheet, just like we did before. But in common size income statements, it helps me to measure what my performance is against my competitor. And where do I get my competitor's information from? From sec.gov, which is where all publicly traded companies publish their financial statements. I think we talked about that at the very beginning of the semester. It was so long ago, most of us probably forgot. But just so you know. Okay, so now that we explored the methods for analyzing financial statements, let's talk about the ratios, okay? Through concepts of liquidity, solvency, and all of the other fun metrics. Okay, so liquidity. Liquidity, as we know, is the company's ability to convert its current assets into cash. That would be like the company's ability to sell its current inventory, and also to be able to convert other short-term investments into cash. These ratios help us to focus on the company's current position, meaning we're looking at the company's current assets and current liabilities. That's liquidity. So there's a couple of ratios that help us in liquidity. We have the working capital ratio. We have the current ratio, quick ratio. Those help us to identify the company's current position. We have accounts receivable ratios. We talked about these ones earlier. I want to say we started talking about this in earlier chapters. We talked about the accounts receivable turnover. We talked about number of days of sales and receivables. And we also look at inventory analysis through inventory turnover and number of days of sales and inventory. All of these ratios are components of liquidity because with accounts receivable and inventory, I can quickly convert those things into cash. That's what makes them liquid. Okay. So let's look at the current assets and current liabilities as from a perspective of the current position to understand, does the company have the ability to pay its current debts, current liabilities? This type of information helps businesses to understand their ability to earn credit with the bank, right? So we're going to look at it from the perspective of three ratios: working capital, current ratio, and quick ratio. The working capital ratio, first one, working capital equals current assets minus current liabilities. And we know where we can find those things, right? Which financial statement can I find current assets and current liabilities? Who wants to answer that question? Which financial statement can I find current assets and current liabilities? Just making sure you're all awake. What do you think? Angela, Birdie, Lakeisha, any of you are free to answer that question. Which financial statement can I find current assets and current liabilities? I know you know this. The balance sheet. The balance sheet, of course, yes. Current assets under assets on the balance sheet. Current liabilities under liabilities on the balance sheet. Very good. So I would look at the balance sheet to understand my working capital by taking current assets minus current liabilities. In this example, we have current assets, current liabilities. 2016, my working capital was $340,000. How did I get it? I took $550,000 minus current liabilities of $210,000 to get working capital $340,000, which is higher than the previous year, which means the company is being more efficient at managing its current working capital structure. It's used to evaluate the company's ability to pay its current liabilities and is monitored monthly, quarterly, yearly by creditors and debtors. But it's difficult to compare it to other companies of different sizes. That's one I guess drawback of that formula. Okay, what about current ratio? Current ratio is also called the working capital ratio. To compute this ratio, we take current assets divided by current liabilities. Looking at our earlier example, we have current assets, $550,000, divided by current liabilities, $210,000. My current ratio is 2.6 for 2016. 2015 was 2.2. Anything above 1 is considered good. Anything above 1 is considered good for the current ratio. And of course, the higher that ratio is, the better the company is in position with respect to working capital. And the more likely the company's ability is to repay its current debts. So the higher the better, right? So the quick ratio measures the instant ability of the company to repay its debts. We also call this the acid test ratio. We call it quick. It's quick, right? Quick. The quick ratio is where we take the quick assets divided by current liabilities. Quick assets. What is a quick asset, you might be asking? Quick assets is cash and anything other than cash that I can quickly convert to cash. For example, I would take a look at my cash, temporary investments, accounts receivables. But I do not include inventory or prepaid assets. The reason why I do not include inventory or prepaid assets is because I cannot quickly convert those to cash. Inventory is sold as it's sold, right? So it's not something I could quickly convert to cash. That's why we call it the quick ratio. Okay, so looking at our company, we have $90,500 in cash, temporary investments of $75,000, accounts receivable $115,000. giving us total quick assets of $280,500. I take my $280,500 divided by my current liabilities, $210,000, to give me a quick ratio of 1.3%. Again, anything higher than 1 is good. Anything higher than 1 is good. So Jefferson Company, they're almost there. They got a little bit ways to go. Let's look at accounts receivable. How do we analyze accounts receivable? Well, accounts receivable, as you know, is a company's ability to collect cash from our customers. Accounts receivable means our customers owe us for goods or services that we've already delivered. Okay? They haven't paid us yet. That's accounts receivable. How do we analyze accounts receivable? We look at 2 ratios: accounts receivable turnover and number of days of sales and receivable. Collecting on accounts receivable as quickly as possible does a few things for our business. It improves our company's liquidity, it provides cash to improve or expand our operations, and it reduces the risk of uncollectible accounts. The accounts receivable turnover ratio is computed by taking sales divided by average accounts receivable. How do we get average accounts receivable? We know what sales are. We know how to get that. That's on our income statement. Top part of our income statement, right? And we have an average accounts receivable. How do we get average accounts receivable? We take our beginning of the year accounts receivable plus our end of the year accounts receivable to get our total accounts receivable, and we simply divide our total accounts receivable divided by 2. So beginning of the year plus end of the year equals total divided by 2. Divided by 2, why? That's how you get an average. Beginning plus ending divided by 2. Beginning plus ending divided by 2. Gets us our average accounts receivable. In this example, $235,000 divided by 2 is $117,500. I take my sales, $1.498 million, divided by average accounts receivable, $117,500, equals 12.7. So your first step, identify your sales. Second step, calculate average accounts receivable. To do that, you take your beginning year accounts receivable plus end of year accounts receivable divided by 2. That gets you your average accounts receivable. Take your sales divided by average accounts receivable to get your accounts receivable turnover. The higher, I don't want to say the higher the better. I want to say higher. What about average days of sales and receivables? Oh. Average days sales and receivables, we take the average accounts receivable divided by the average daily sales. So how do we get average daily sales? We take our total sales divided by 365 days. That gets us our average daily sales. Average accounts receivable, again, you take beginning of the year accounts receivable plus the end of the year accounts receivable divided by 2. That gets you your average accounts receivable. To get your average daily sales, we take your total sales divided by 365 days. Then what do? We take average accounts receivable divided by average daily sales to get the number of days sales in receivables. The lower the better. Lower the better. So just remember the steps that you take. Yeah, that's what it's all about. Anytime you're faced with a difficult formula, take everything by steps. Take everything by steps. The more you do that, the easier it gets. The number of days sales and receivables estimated in terms of time, number of days. Accounts receivable has been outstanding. Number of days in sales receivables often compared to the company's credit terms and evaluate the efficiency of collection of receivables. In other words, we compute these two formulas to best understand the company's ability to collect on its receivables, and it also helps to determine the company's credit worthiness. Okay, talked about receivables. Now we got to talk about inventory. We analyze our company's inventory in order to determine our company's effectiveness in turning over its inventory, selling its inventory. And to do that, we look at two different formulas: the inventory turnover ratio and the number of days sales in inventory ratio. These ratios help us to identify decreases in liquidity, increases in insurance expenses, property tax costs, and other related expenses, and also helps us to identify increases in the risk of loss because of the price decline, obsolescence, and inventory. In other words, all of these factors help us to identify an excess in inventory. In other words, do I have too much inventory on hand? Inventory turnover. We take the cost of goods sold, which comes from your income statement, divided by average inventory, which comes from your balance sheet. How do we get average inventory? We take the beginning of the year inventory plus the end of the year inventory divided by 2. Beginning of the year plus the end of the year divided by 2. We take cost of goods sold divided by average inventory to get our inventory turnover. So cost of goods sold, 1.043 million, divided by average inventory of 273,500 equals 3.8. What about number of days sales inventory? How do we compute that? We take our average inventory divided by average daily cost of goods sold. To calculate average daily cost of goods sold, we take our total cost of goods sold divided by 365. Average inventory, how do we get it? Beginning of the year inventory plus the end of the year inventory divided by 2. Gets us average inventory. To get the average daily cost of goods sold, we take total cost of goods sold divided by 365. To get the number of days sales in inventory, we take our average inventory divided by our average daily sales cost, average daily cost of goods sold, equals the number of days sales in inventory. The lower, the better. It's a rough estimate for the amount of time it takes to purchase, sell, and replace inventory. So the lower, the better. So that's inventory. What about solvency? Solvency. Again, solvency is the company's abilities to pay all of its debts, including long-term debts. There are a couple of ratios that we can compute to figure out if the company has the ability to pay all of its debt. We have ratio of fixed assets to long-term liabilities, the ratio of liabilities to stockholders' equity, and times interest earned. So let's look at each one. The ratio of fixed assets to long-term liabilities tells us how much fixed assets the company has to support its long-term debt. Measures the company's ability to repay the face amount of the debt, and it's computed by taking our fixed assets, net fixed assets, divided by long-term liabilities. And of course, you can find the fixed assets, which is property, plant, and equipment under fixed assets on the balance sheet. We can find long-term liabilities on the balance sheet. So here's some data. 2016, our company had $444,500 worth of fixed assets. Our long-term liabilities were $100,000. So we simply take our fixed assets divided by long-term liabilities and gives us the ratio of fixed assets to long-term liabilities, in this case 4.4%, which in this case, the higher the better. What about the ratio of liabilities to stockholders' equity? This tells us how much the company is financed by debt and equity. I like to call this ratio helps me to understand what percentage of the company is financed by both debt and equity. That's how companies raise cash, right? Is through debt and equity. That's how they finance their operations. What percentage of their business is financed for operations? We compute the ratio of liabilities to stockholders' equity. We do that by taking total liabilities divided by total stockholders' equity, both of which we find on the balance sheet. For our company in 2016, we have total liabilities of $310,000, and we have total stockholders' equity $829,500. We take our $310,000 divided by $829,500, total liabilities divided by total stockholder equity. In this case, our ratio is 0.4. 0.4. The lower, the better. The lower, the better. Times interest earned. Times interest earned is also called the coverage ratio. It helps us to identify the risk that interest payments will not be made if earnings decrease. To compute this, we take our income before income tax plus our interest expense divided by our interest expense. I'll give you a hint. You could find these items on our income statement. Income statement. The income before income tax is found toward the bottom of the income statement. The interest expense is also found toward the bottom of the income statement. The higher this ratio, the more likely the interest payments will be paid if earnings decrease. So let's take a look. In 2016, income before income tax was $162,500. Our interest expense was $6,000. Our amount available to pay our interest is $168,500. How do we get this amount? We took our income before income tax plus our interest expense. We take that amount, divide by our interest expense to get the times interest earned ratio. In this case, it's 28.1% in 2016, which is good. The higher, the better. Now, how do we figure out how profitable our company is? Through profitability analysis. We look at the company's ability to generate revenue in the future. And it depends on a couple of factors. The company's operating results, meaning how much revenue the company generates over time by using its assets, and how much the company has available to use in its operations. So we look at the relationship between the income statement and balance sheet to figure this out. Income statement tells us the revenue. The balance sheet tells us our assets. We're looking at the relationship between our revenue and our assets. So of course, there's a couple of different ratios we can compute to figure this out. We have the asset turnover ratio, return on total assets ratio, return on stockholders' equity ratio, return on common stockholders' equity ratio, the earnings per share on common stock ratio, price to earnings ratio, and dividends per share ratio, and our dividend yield. It's a lot, I know. But I promise you the formulas are very straightforward. The asset turnover tells us how effectively our company is using our assets. We take our total sales, which is found on our income statement, divided by our average total assets, excluding long-term investments. Okay? Long-term investments are excluded because long-term investments are unrelated to normal day-to-day operations. So we take our total sales divided by our average total assets. How do we get average total assets, you might be asking? We take our assets at the beginning of the year plus our assets at the end of the year divided by 2 to get our average total assets. Our total assets at the beginning of the year plus end of the year divided by 2 gets us our average total assets. We take our sales divided by our average total assets to get our asset turnover ratio. Higher the better. What about return on total assets? It measures the company's profitability of total assets without considering how the assets are financed. In other words, we don't care about the portion of the business that's financed. So to compute this ratio, we take our net income plus our interest expense divided by average total assets. Net income found on the income statement, interest expense found on the income statement, average total assets, that's beginning of the year assets plus end of the year assets divided by 2. So income net income, $91,000. Interest expense, $6,000. We add those two together to get $97,000. Average assets, beginning of the year plus the end of the year divided by 2 is $1,185,000. So we take our net income plus interest expense, which is $97,000, divided by our average total assets. Equals 8.2% return on total assets. The higher, the better. Return on operating assets is sometimes also computed to discover return on total assets. And to figure out return on operating assets, we take our income from our operations divided by our average operating assets. Now, what about equity? Return on stockholders' equity. It measures the rate of income earned on the amount invested by our stockholders. To figure that out, we take our net income divided by our average stockholders' equity. Remember, every time you hear average something, average total something, it's beginning of the year plus the end of the year divided by 2 of whatever that is, right? So to get our return on stockholders' equity, we take our net income divided by our average stockholder equity. Beginning of the year plus end of the year divided by 2. So net income divided by average stockholders' equity equals, in this case, 11.3%. And again, the higher the better. Return on stockholders' equity is normally higher than the return on total assets because of what we call leverage. Leverage involves using debt to increase the return on an investment. That's what leverage is. So to compute our leverage effect, or effect of leverage, we take our return on stockholders' equity percentage minus our return on total assets to equal our effective leverage. And this is what it looks like in comparison to the previous year. You don't have to worry so much about it. It's nice to know. You don't need to know. Let's look at the return on common stockholders' equity, where we look at the rate of profits earned on the amount invested by the common stockholders. For this computation, we take net income minus preferred dividends divided by average common shareholders' equity. Net income we know is on the income statement. Preferred dividends we know is going to be on the equity statement. Divided by average common shareholders' equity, also on the equity statement. Okay, so we have net income minus preferred dividends. We get our total. And we have to get our average common shareholders' equity, beginning of the year plus the end of the year, divided by 2. So we take our net income minus preferred dividends divided by average common shareholders' equity equals the return on common shareholders' equity, in this case 12.5%. The higher the better. And we could look at our percentages expressed from year to year, our ratios expressed from year to year, to better understand our leverage using stockholders' equity. And that's why we could do these types of computations. Earnings per share. This tells us the share of profits that are earned based on each share of common stock. Earnings per share is reported on the income statement. It's toward the bottom. It's actually at the very bottom of the income statement. Earnings per share, how do we compute it? We take net income minus preferred dividends divided by shares of common stock outstanding. So net income minus preferred dividends divided by common shares of stock outstanding. 82,000 divided by 50,000 equals $1.64 per share. And many companies use this to help value the company in the future. So another ratio as it relates to shares is called the price-earnings ratio. It's a measure of common stock in comparison to figure out its future earning prospects. What's the company's earning potential in the future? That's why we call it price-earnings ratio. So we take the market price per share of common stock divided by the earnings per share of common stock. Market price divided by earnings per share equals the price-earnings ratio for common stock. Good news is we don't go too deep into that in this course. It's more for finance courses than anything else. Dividends per share measures the extent of which earnings are being distributed to common shareholders. To compute this, we take the dividends on common stock divided by the shares of common stock outstanding. Dividends on common stock divided by shares of common stock outstanding. In this case, 80 cents per share. That's the dividend that the company could pay out in 2016. Comparing dividends per share indicates the extent of which earnings are being retained for operations. Last one is dividend yield. Dividend yield on common stock is a measured rate of return to common shareholders from cash dividends. That's why we call it yield. It's what's left over, right? This is very interesting for investors because it tells them about the dividends from their investments. To compute dividend yield, we take dividends per share of common stock divided by the market price common shares per stock. Dividends common share per stock divided by market price common shares per stock. In this case, 2%. 2% is pretty good. Now, these last three slides, these are summary slides, okay? while you are taking the final exam, I want you to be very aware of these last 3 slides in the Chapter 14 presentation. These last 3 slides are summaries of the computations for each ratio. Okay, because we just covered a bunch of ratios. We covered what, 10, 12, 14 ratios? So because there's so many ratios, these last 3 slides are really used to help you. Instead of having to keep digging through, it just summarizes computations. Now remember, when we see average, average daily, average inventory, things like that, average, the beginning of the year plus the end of the year divided by 2. That gives you average. Yeah? Just keep that in mind. And that, my friends, is the end of Chapter 14 and the end of Accounting 201. Are there any comments, questions, concerns that I can help to answer for you as it relates to either Chapter 14 or anything that we've covered in this course? Anything at all? Angela, Bertie, Lakeisha. Any comments, questions, concerns?
No, sir, you said a mouthful. Oh, I'm sorry. You said a mouthful, Professor. So everything's been great so far for me. Thank you.
Awesome. Thank you so much. I appreciate that. Miss Harris or Miss Harris? Any of the Harrises? Bertie, Lakeisha? Both okay?
A lot to absorb.
Yeah,
We're getting there.
absolutely. And if you have anything that comes up over the next few days, definitely before Sunday, because all of your work is due on Sunday. Anything remaining, anything that needs to be redone, including Chapter 14, all of that is due this Sunday. I can't go past this Sunday because the final exam is on Tuesday. So please, if you think of anything at all, just please reach out to me, call me, email me. I'll help you out, I promise.
Professor, I do have a question.
Lakeisha.
I'm running into the issue doing the extra credit.
Okay, yeah.
It's asking to verify, verify you as a student. And when I try to download anything from BDC from registration saying that I am a student, it's not uploading. So is there another way we can do it on getting the extra credit, or just let it be?
Student ID. Can you copy that and upload that? Have you done that?
I can just screen upload it because that's for upload. Maybe I could save it as a Word document and upload it.
Yeah,
Hopefully that can take it.
give that a shot. That might work.
Okay, then cool. I'll try it again.
If not, it's really not the biggest deal. But
Okay.
it's extra credit. So
True. That extra credit can help in them assignments that I didn't get all the way.
it can, or you can try to retake some of those homework assignments and try to earn a higher score.
Oh no.
It's your other alternative.
No. The grade submitted. I'm good with the grade. I'm cool with it. I'm not. I'm still in the A. I'm good.
Well,
I'm straight.
well, I'll tell you what, Miss Bertie Harris, I know that she's doing that, and tell me, Miss Bertie Harris, is that helping you out?
It is. It's giving me a gray hair, but it's working.
Yeah, see, no, I'm good. I'm good. I'm still working as we speak.
It's
I don't need
okay.
nothing extra. I'm still on my day job right now.
I understand. Well, listen, I appreciate, especially the three of you ladies. I really appreciate you spending time with me. I think that we had a good semester together. I hope that what you learned you'll carry with you, and I hope that you are going to take me again in the future, especially for Accounting 202, which I'll be teaching on Monday nights in the next semester. And I'll also be teaching it on Tuesday mornings. So the Tuesday morning one is an 8-week course. The Monday nights, that's a full 15 weeks. So hopefully you've already registered. And I'll see you there.
I did, and I'll be there, Professor. I'll be in the Monday class.
Cool. Sounds good.
I think I picked the Monday class. I hope I didn't pick Tuesday because I'm sure it's at work at that time.
Oh, yeah. And I tell you what, that Tuesday one, it's 2 chapters per week. It's very condensed. It's very hard. Well, not hard, but it's the same content. It's just faster, which means more work each week. So, something to think about.
Oh, you
Well,
said
I'm
so
glad
the
I chose
Monday
that Monday
is
class.
I'm
the
sorry. Yeah, so the Monday class is 1 chapter per week. The Tuesday class is 2 chapters per week. So it's always interesting. But either way, I'm looking forward to seeing you all next semester. And having said that, I hope you have a wonderful night. Get some rest. Start the final exam early. Start working on it now. Take your time with it. Don't feel overwhelmed. Certainly don't wait till the last minute. Please don't do that to yourself. Don't stress yourself out like that. I want you to start it early, save your work, read as much as you can, try to practice problems. Just do everything you can to prepare yourself for it. Okay? And if you have any questions along the way, you let me know.
All right, sir.
Awesome.
okay. I'll see
Thank
you
you
on
so
Monday
much.
because I'm on a Monday class. I just checked real quick.
Okay, that sounds good. Well, I'll see you Monday nights next semester, starting
Yeah.
the
I checked that real
second week
quick.
of
I don't got
January.
time.
In about a month from now, I'll see you in about a month from now on Monday.
Okay.
Absolutely. Thank you so much
All right, thank you.
for
Thank you
your
all
time
so
and
much.
effort.
And again, anything you need, you just let me know. Okay, I'm here to support you 100%.
All right,
Thank you
thank
so
you.
much,
Thank
Professor.
All right,
you.
thank you. I
Take care.
appreciate you, Beth.
Have a
All right,
wonderful
take care.
night. Stay
Have a
safe.
You
good one.
too.
And
Thank
I
you.
know you'll do well in that final. You guys got this. I know.
Thank
All right.
you.
Okay.
Take care.
Thank you.
Thank
Take
you.
care.
Have a good one.
Good night.
Bye-bye.
Bye-bye. Thanks, everyone.